Hello, everyone. Welcome to another episode of Market Makers. Today, we have with us Mr. Aditya Biyani, Chief Corporate Strategy and Investor Relation Officer at Star Health. Welcome, sir.
Thank you. Thank you for having me on the show.
Without much ado, let's begin, understanding the company directly from the, management of Star Health. So, you might be aware that Star Health started in 2006. So, Aditya, please tell us about the company story from then on and where does it stand in the industry currently in terms of market share?
Fine. So Star Health and Allied Insurance Company is India's first standalone health insurer, which has its business interest in health insurance, personal accident, and overseas mediclaim policy. It began its operations in the year 2006. So for the first financial year, which is 2006 to 2007, we did a business performance of 22 crores. And in the last financial year of 23, we did 12,950 crores of GWP. Star Health continues to maintain a market leading position year on year with 34% of its retail market share. So that means that every third policy which gets sold in the retail health insurance piece, it's of Star Health. We have our headquarters in Chennai, and the company has ensured its reach is wide and extensive with almost with 830 plus branch offices, 700 plus sales manager stations. We also have tie-up with 14,000 plus hospitals and diagnostic centers. We have 6,500 plus sales managers, which look after 6 lakhs plus agents. And we have an in-house team of 500 plus qualified medical professionals.
Okay, that's an expansive network that you have. So just understanding the industry, taking a slightly bird's eye view and understanding what according to you and as per industry reports, what is the outlook of Indian health sector, and what are the triggers that that could lead to growth?
So the health insurance industry in India is composed of three segments: retail, group, and government health. When we include all the three segments, it's almost touched around 95,000 crore of gross written premium, out of which retail would be around 35,000 crore to 36,000 crore. Star Health's focus is on the retail health segment. In the past 4 years, the retail health segment for the entire segment has grown at a CAGR of 18%. We expect similar industry growth trajectory in the coming years also. Star Health, as I mentioned, has had a 34% retail health share as of financial year 23 versus a 24% in the financial year 18. And we expect our company to grow faster than the industry and continue to increase the market share. Coming to your second point on key growth triggers, I'm sure you must have realized post-COVID, the awareness level in India is extremely high, but the penetration is extremely low. When I say penetration, almost 10% of the household is only covered by health insurance, and or probably you can say 51% of healthcare expenditure of India is out of pocket, wherein the world median is around 26%. So we are almost double. So the room for growth is extremely, extremely high. The insurance regulator is also taking very active and progressive steps to increase penetration of health insurance. There is a lot of product innovation which is happening. One more segment, the rising income levels in India is also increasing the tax filing demographic segment of the population. So with tax benefits available on health insurance, a rising income level will also lead to a growth of retail health.
Got it. Clearly, many triggers that could, lead to growth in the health insurance sector. Now, let's get a little specific. So, could you tell us what is Star Health's business model?
So India is a country of reach, considering its huge geographical spread. So to cover this various demographic segments, we have four verticals with dedicated teams in agency, bank assurance, digital, and group. We are expanding our market share by sticking to the core strategy of agency. Agency contributes to almost 80% of our total GWP. As I had mentioned, we have 6 lakhs plus agents who are driving this. Agency plays a vital role as such in retail health, as health is an assisted product. So we are leveraging a strong brand in the retail health insurance sector. to attract quality agents and build our agency distribution network. Along with agency, we are also expanding our use of other alternate distribution channels, especially our corporate agent banks channel and other channels, including digital vertical. We are expanding our offerings on products also by creating innovative products and adding innovative features such as air ambulance. We are also expanding our reach to newer geography, which is less than 1 lakh population. So we have 140 odd branches in less than 1 lakh population. We have 51 branches in 1 lakh to 2 lakh population. We are also using digitization in our business to improve operational efficiencies and customer service. So basically, if you see, Star works on a phygital model, a physical branch and a digital onboarding of the customer.
Mm-hmm. Okay. So clearly, you have a leading position in the retail health segment. So could you throw some light on what is the company doing to increase this market share from here?
So Star Health, as I mentioned, had her 34% retail health market share in financial year 23 versus 24% in financial year 18. We expect a company to grow faster than the industry. Last year, the industry grew at almost 15.3%. We grew at almost 18 odd percent. Insurance agent brings about 80% of our business. In the financial year 23, the number of agents increased to 6.25 lakh agents from a 5.5 lakh agent base. Our strategy is to hire agents, train them, develop them. We have a very dedicated training team who takes care of this. So it's just not recruiting, it's also handholding and mentoring them how to sell a health insurance product, which has become a necessity rather than a luxury post-COVID. We intend to add almost 1 lakh agents every year, taking our number to 1 million in the next 3 to 4 years. We also have 835 branches, as I mentioned. And these are the branches which supports the intermediary in sourcing, in getting trained, and also in policy servicing.
Mm-hmm. Okay. So it's generally observed that, successful companies thrive on product innovation. So, what kind of product innovation you are doing and how these products are, you are able to differentiate, compared to your competitors.
So our products have a track record of innovation in industry first. So we intend to continue to innovate and design new products and solutions to cater to the varying needs of our existing and potential customers. Now we can do it through innovative products like coverage of an organ donor expenses in connection with organ transplants. We have disease-specific products like diabetes care, cancer care, and also demographic segmentation. We have women's care product. We have a young star product, which is catering to less than 40 years of age. So we cover almost every demographic segment of the population.
Okay. And after a point, understanding the business model, investors may also want to know, something about financial ratios. So we observed that in FY23, the company was able to lower its combined ratio. So what did the company do to come to this kind of a figure? This is the most important ratio to check when you are analyzing and comparing insurance companies. Now, this combined ratio is a measure of profitability of an insurance company from its core business after factoring in its claims expenses and operating expenses. So let's say an insurance company earns 100 rupees as premiums by selling its policies, while it spends 70 rupees on claim settlement and 25 on operating expenses. The combined ratio comes to 95%, which shows the insurance company is running a profitable business. Lower the combined ratio, better it is.
So in financial year 23, our combined ratio fell to 95.3% versus 117.9% in financial year 22. This fall was largely attributed in the reduction of claims ratio to 65% versus 87.1% in financial year 22. So we work actually on a four-pronged approach to effectively manage claims. Prudent claim settlement based on rich medical expertise and insurance wisdom. As I mentioned, we have 500 plus medical professionals in our team. At the same time, we also have a very volume-based pricing agreement with network hospitals which gives us operating leverage in terms of lower average claim size. We are working with immediate focus on technology, which can enable us on fraud detection and mitigation. Risk-based pricing is also done through micro-segmentation of portfolio. In fact, our anti-fraud digital initiative has started to produce savings in our claims outgo. There is a 1.3% incremental benefit in terms of lower claim ratio in financial year 23 as against financial year 22.
Compared to manufacturing companies or banks, companies in the insurance sector are evaluated on totally different types of ratios. A critical among them is the claims ratio. Claims ratio is also referred to as loss ratio. Now, in simple words, claim ratio is the money paid by the insurance company as claim settlements versus the total money earned through premiums from its customers. So let's say an insurance company pays 80 rupees as claims. Out of the total 100 rupees earned as premiums, the claims ratio would be 80%.
Now, combined ratio has claim ratio, expense ratio. There are two factors. So when it comes to expense ratio, which is the second component of the combined ratio, our expense ratio fell in financial year 23 to 30.3% to 30.8% on account of efficient cost management.
There are certain costs involved in running an insurance company, costs such as management expenses, commission paid to the agent. Of course, these expenses are paid out from the premiums earned by the company from its customers. But when you divide these expenses by the premium earned, you get the expense ratio. The expense ratio tells us how efficiently the insurance company is running its operation. Lower the expense ratio, better it is. So, Aditya, you talked about, being a digital company. So what are your digital initiatives? Could you, shed some light on that as well?
Yeah. So digital, obviously, you cannot ignore. In fact, we do digital spending not only on sourcing of the business, but also on the servicing. So on the sourcing, digital sales contribute to 7% of our business through web sales, telesales. And digital brokers and web aggregators are also included in this 7%. The direct business is almost 70% of our overall digital business. And all the other channel partners, like the web aggregators and the digital brokers, constitute the balance 30%. Our web aggregator contribution is less than 2% of our overall business. And we have relationship with these channel partners for more than 10 years. As I had mentioned, health is a very assisted product. You need to nudge the customer to buy it. So while leads are generated online, there is a telesales unit who calls on the customer to complete the sales. And this is also true for the web aggregators in the industry too. We expect our direct channel will grow faster than our channel partners on the digital side. We are noticing a 35% growth in our digital vertical side. We will continue to invest in direct business. Online business is obviously more profitable in the long run because we are able to control the quality of business and there is no trailing commission given on these sales. So today, agents are also using digital means to complete their sales process and avoid manual work. The biggest testimony I'm sure you also must have seen is during the pandemic, when during lockdown, submission of documents, payment process, everything was done end to end digitally. Coming to the digital service now, we are creating digital processes for service to enhance customer experience, reduce cost of operations, and in that process, have a faster turnaround times. Straight through processes are created to ensure hassle-free issuance. Today, SME quotes can also be generated online, and also their payments can also be made digitally. So online issuance of the policy is almost 62% of our total business. I'm sure digital is the way forward. It plays a major role in claim servicing also. We can use WhatsApp, for example, for our claims document submission. So we are invested heavily on digital, and we feel that's the way forward, which I'm sure the industry is also looking at.
Excellent. So, as a company, you are banking on growth from higher sum assured products. Now, could you explain to us and our viewers what does this term mean, higher sum assured products? And how does it help in your overall business?
So every policy you'll have to select either a 1 lakh sum insured or a 2 lakh or a 3 lakh. That's the limit which a company will insure the policy holder. Now, higher sum assured are beneficial to all the stakeholders. And when I speak about stakeholders, there are policy holders. It helps them because they can mitigate the impact of rising medical inflation to some extent. Second is agency. The agents, because their average ticket size will increase. With average higher ticket size, they will earn higher commission. And for the insurance company, a higher sum assured products means higher premium and a lower claims ratio. 70% of our product portfolio is 5 lakhs and above. So we are trying to educate our customers and our agents to sell a higher sum assured product.
Got it, got it. So I assume that, in a general parlance, it does give you an economies of scale
Absolutely.
when you're selling these kind of products. Understood.
Yes.
Also, tell us more about providing wellness benefits to the customers, and how does this translate into business in the long run?
So health insurance in India is a nudge product. You need assistance to sell this product. Similarly, wellness benefits are a nudge to policyholders to improve their fitness level. Now, based on certain fitness targets, customers can get a renewal discount or benefit. Now, this results in a healthy cycle as fitter customers are less prone to claims. So, wellness actually is a core plank of our insurance offering, and we believe that demand for such benefits is likely to grow exponentially in the coming years.
So, not many investors would know that an insurance company not just makes money out of the premiums, but it also invests that money, into various investment avenues and generates income from that. So, tell us more about Star Health's investment portfolio, and also how the company is optimizing this portfolio for better returns versus the managing the risk associated with it.
So good. So a company's profit comes from underwriting profit and investment profit. So as regards to investment, the philosophy is investing in quality paper to improve the overall portfolio yield. What it means is we believe in the SLR philosophy: safety first, liquidity second, return third. Having said that, AAA and government securities contribute to 75% of the portfolio. Almost 2% of our portfolio is on the REITs and InvITs. We have recently taken exposure on the ETF side for equity. It's to the extent of 5%. The good part is the hike in interest rate is positive for our portfolio, as it will mean that the maturity proceeds from the old investments can be reinvested at higher yields, thereby leading to higher interest income.
Got it. Taking a step further on this, and understanding the company's return ratios, such as return on equity. So, what we've seen is, Star Health's return on equity currently is lower than other major players. So, what is the company doing, on this front to improve this ratio?
So our financial year 23 ROE was impacted by a one-time ESOP cost. Having said that, our ROE was 12.4% for the financial year 23. Going forward, we expect ROEs to normalize at 18 to 20% over the coming years. In fact, the implementation of IFRS in financial year 25 will give a further boost to our ROE, as it will help us to disclose the true economic ROE rather than the accounting ROE.
Got it. Excellent. And what, according to you, could be a tipping point from there on, the company would start giving dividends to its shareholders?
So we feel that we are currently in the high growth phase and we do not expect to pay out dividends. We look to revisit this decision probably after next 4-5 years. The penetration is low, the growth is happening very healthy. So we would not, we don't expect to pay out dividends.
Now, coming on the, at a, industry level, what are the broader growth trends that you are seeing in the industry, especially the Indian health insurance industry, and which, according to you, those among those trends will work in your favor?
So firstly, very low penetration and maximum awareness thanks to COVID. So when we speak to our advisors or our end customers, he always says that there is never a no when the advisor pitches a health insurance to any of his customer. That means every bread earner in the country is thinking of taking a health insurance for its dependents and for himself. So health is wealth. The real concept is coming into the scene, because whether you're a sports person or a film personality, you must have seen people have got heart attacks at 45, 55. We are living in a very stressful environment. So we feel that the awareness and low penetration is a plus point for the entire health insurance industry. Increased uptake of higher sum assured policies, which we spoke a bit back, is a win-win for the insured as well as the insurance company. One more very positive thing which is happening for us, at least, is that the smaller non-metro cities or the rural areas are demonstrating very good awareness for the need of health insurance. Appreciation for wellness benefit has increased in the industry. The demand for preventive healthcare is reflecting in the the demand for wellness benefit, where a customer gets a discount or benefits if they fulfill certain fitness related criteria that are mentioned in the policy. There's a good demand for digital health services post COVID-19, and that is likely to be a structural change rather than just a temporary effect. Star Health is also providing telemedicine service, a remote monitoring tool to meet this new demand.
Understood. Yeah, definitely. Especially post pandemic, there has been a broader and awareness about having an health insurance, and that too having a larger one that would cover the medical cost. Understood.
Yes.
But in general, what are the challenges and risks that a health insurance company in India has?
In fact, it's a very good question. The biggest challenge is the lack of any regulator for the hospital sector. So we have tried to address this by having an agreed pricing with various healthcare providers. Medical inflation is also another challenge. Now, medical inflation ranges from the rise in cost of medicines to doctor consultations to the hospitalization. Lab tests and surgery procedures have become expensive. So with healthcare prices shooting up, the hike directly affects the insurance industry, leading to an increased premium for our customers. So the biggest challenge is the rising medical inflation and lack of regulator in the hospital sector.
Got it. Now, something about the investors in general, what according to you are those 5 KPIs that any investor must track for a general insurance company?
I would say the 5 KPIs would be the gross written premium first, the loss or claims ratio, the expense ratio, the combined ratio, and the solvency ratio. I think these are 5 important parameters which everyone should look into, because the more you grow, the better it is for the organization. Your operating leverage will be better. Your combined ratio will be lower. You'll start making underwriting profit. So I think these are the 5 KPIs: the gross written premium, the loss ratio, the expense ratio, the combined ratio, and the solvency ratio.
Thank you so much, Aditya, for summarizing this so well. And again, many thanks for taking out time for this interview. I hope the way you've explained about the entire industry and also about Star Health would help investors to take a better decision.
I am so grateful that you had me on the show. In fact, we always believe that in the 70s there was a nara of roti, kapda or makan. Now the nara should be roti, kapda, makan or health insurance. Thank you so much.
Thank you, Aditya.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.